Hello, welcome to this edition of FedWatch. I'm Brian Beaulieu from ITR Economics, and today is January 12th, 2024. There's really 4 points I want to go over today, and we'll cover them briefly as we try to do all the time. One is that the December CPI report was released yesterday. We've gone through the numbers, looked it over, and you no doubt have read by now that the CPI was slightly elevated from where it had been. The 112 rate of change, so the latest monthly data compared to December 2022, ticked up to 3.4%. Had been 3.1, then 3.2 in November, now it's 3.4. Obviously, for all of us who want lower interest rates, or for the economy doing better with lower interest rates, it would have been better to not see the 3.4, but I don't think it's as problematic as some people may make it out to be. The 312 rate of change is still in phase C at 3.2, so it is still edging down. And we use the 312 a lot because it takes some of the 112 choppiness, the noise out of it. So we're still getting that disinflation trend going. By the way, the 3.2% came in 0.5 percentage points higher than our forecasted average 312 for December 23 that we put out there when we had October 2022 data. So more than a year in, the overall trend is still behaving as we expected, 0.5 percentage points higher than average, well within the forecast range. It's very apparent going through the data that commodities are staying low. The real issue happens to be, or continues to be, the labor content of what's included in the CPI. For instance, as an example, food was up 2.7% year over year, but food away from home was up 5.2%. And the difference there being obviously the overhead of the restaurants and the staff, the cooking, and all of that. Energy showed a big year-over-year decline. Fuel oil was down 14.7%, and natural gas is down 13.8% year-over-year. So big decline in commodities. If you look at, and you've heard the expression so many times right now, the core CPI, which isn't a critical number for the Fed, but it's a good gauge of where the PCE deflator is going to be going. That came in at a respectable 3.9%. It's in phase C, that 112 rate of change, so that is getting better. But you notice it's higher than the overall CPI, which came in at 3.2%. But we're making some progress there. Like I said, it's in phase C, and a year ago it was at 5.7%. It's really the services components that's keeping this up. If you look at not the overall CPI core, but you look at commodities excluding food and fuel, that rate of inflation was only 0.2%. So the difference has to be in labor costs. That's giving us this 3.4% reading for December. And it's not too hard to find it. You look at shelter inflation, that's up 6.2%. That's a burden for a lot of households. We looked at transportation, which was another biggie, keeping the CPI up, elevated. It was at 9.7% for the year. And within that, insurances continue to be the major thorn. The insurance costs are up over 20% year over year, and getting your car fixed alone is up 9.7%. So it's the labor content that we need to see some changes in. Point number two is, and then we'll talk about that labor content. Point number two is the showing was strong enough in terms of inflation not being as quiescent as probably wanted by the Fed, that it's unlikely we're going to get a change in interest rates in the first quarter. Hope I'm wrong, but we're still thinking it's going to be the second quarter of 2024 before the Fed starts to lower interest rates, but we still expect that they will be lowering interest rates at that time. In terms of those labor costs, wage growth is up 5.2% year over year. And the CPI being up 3.4%, the difference being between those two numbers showing you that real wages after inflation wages are rising better than the overall rate of inflation. We're seeing wage growth, in other words. And that's going to present a bit of a problem for the Federal Reserve because they want to see the wage growth slowed down, and it really isn't as yet. The good news in that, though, and in economics, good news, bad news, that's why a lot of people don't like economists. The good news is consumers are continuing to have more money, more income than they had a year ago. The bad news is a lot of it's getting sucked into paying insurance bills and non-commodity things like shelter. I also took a look at initial jobless claims and unemployment insurance claims through December. And that shows that we're still in a very tight labor market. It's hard to gauge that when all you're doing is picking up on the data out of the media. But for instance, the third quarter to fourth quarter change in initial unemployment claims was up, but it was much milder than normal in terms of its increase. And that also is going to be a problem for the Federal Reserve. We're going to need to see some more softening in the labor market before I think the Federal Reserve is going to be comfortable lowering interest rates. So it was mixed bag with the December CPI. Labor remains tight, remains a problem for a lot of folks. We are still encouraging people, our clients, you don't need to give the same magnitude wage increase that you gave over the course of 2023 because of the softening economy and because inflation is still coming down. We're in good shape for this recession in 2024 being mild, but the operative word there is recession, and that means the Fed will give on these interest rates. Thank you for joining us for this edition of FedWatch.